The 5 best dividend stocks to buy in 2024 that beat inflation. With inflation stubbornly hovering above 3%, beating it isn't just about holding onto your cash, it's about growing it. In this video, I'll show you 5 dividend stocks that not only protect your wealth from inflation, but also position you to get richer in 2024. One of these stocks has quietly increased its dividend payout by over 11% in the last 5 years, making it a powerful inflation buster. Stick around, you won't want to miss these picks. But before we get into the best dividend stock picks, let's look at inflation's main challenges for investors like you and me. 1. Less value for money. As prices rise, money loses value. This means you need more money to buy the same things. 2. Lower savings power. If your investments or savings don't grow as fast as inflation, you might actually be losing money over time. 3. Uncertain returns. Some investments may not keep up with inflation, meaning they might not give you the returns you need. Now that we know the challenges investors face, we'll be sharing 5 dividend stocks that can help protect and grow your wealth, even when inflation is high. These stocks belong to a special group known as dividend aristocrats, companies that have steadily increased their dividends for 25 consecutive years or more, helping people build wealth over time. We'll go through the list from good to the very best. First off, let's know what dividend stocks are. Dividend stocks are shares of companies that pay you money regularly, called dividends, just for owning their stock. This money usually comes from the company's profits. So by investing in dividend stocks, you can create a source of income that not only helps you build wealth, but also protects you during times of inflation. Let's begin with the 5th pick, Medtronic, known by the stock symbol MDT. Medtronic is a leading company in the healthcare sector. It offers a dividend yield of 2.3%, which is higher than the S&P 500 average of 1.4%. If you start with an investment of $10,000, Medtronic's status as a dividend aristocrat means steady growth. Over the past 5 years, its dividends have grown at an annual rate of 7.9%, showing its reliability. Medtronic might be a good buy right now because they could be undervalued, meaning the stock price might be lower than it should be. This could be due to recent developments or new products that could boost their future value. The last dividend per share paid by Medtronic was 69 cents. So if you owned 1 share, you would have received 69 cents in dividends. Medtronic has been increasing its dividend payouts for over 46 years, similar to getting a pay raise every year for 46 years straight. The company makes a wide range of medical products, from insulin pumps to surgical tools, which are always in demand because healthcare is a basic need. Let's look at our 4th pick, Diamondback Energy, known by the stock symbol FANG on the stock market, which is an oil and gas company. They extract oil and natural gas, mainly in Texas. Diamondback Energy is part of the energy industry, which includes companies that produce and sell energy, like oil, gas, and electricity. Diamondback Energy has a dividend yield that shows how much money you can earn from dividends compared to the stock price. However, investors should not focus too much on this yield. The company pays out a portion of its free cash flow as dividends, known as the payout ratio. For Diamondback Energy, they use about 75% of their free cash flow to pay dividends to shareholders. Diamondback Energy might be a good buy because the market could be undervaluing them right now, meaning their stock price might be lower than it should be. This could be due to a recent major acquisition or something new happening in their business environment. Diamondback Energy Incorporated's latest ex-dividend date was on August 15, 2024. The FANG stock shareholders received the last dividend payment of $1.44 per share on August 22, 2024. Overall, while dividends are important, it's crucial to look at the bigger picture, including how the company is valued and its growth potential. Now let's move into the industrial sector with our 3rd pick, ExxonMobil, known by the stock symbol XOM. ExxonMobil is one of the biggest oil and gas companies in the world. They explore, produce, and sell oil and natural gas, and they are part of the energy industry. ExxonMobil offers a dividend yield, which is the amount of money you can earn from dividends compared to the stock price. But remember, investors shouldn't focus too much on this number. ExxonMobil uses about 50% of their free cash flow to pay dividends to shareholders, which is their payout ratio. ExxonMobil might be a good buy at the moment because they could be undervalued, meaning the stock price might be lower than it should be. This could be due to recent changes in the market or a major acquisition they've made, which could increase their value over time. The last dividend per share paid by ExxonMobil was 95 cents. So if you owned one share, you would have received 95 cents in dividends. Let's take a brief look at history to understand the impact of inflation. One of the most extreme cases occurred in Germany during the Weimar Republic era in the early 1920s. Hyperinflation caused prices to skyrocket, with the cost of everyday goods rising to unbelievable levels. For example, in 1914, a loaf of bread in Germany cost about 15 Pfennig. By 1923, during the height of hyperinflation, that same loaf of bread could cost billions of marks. People's savings became worthless, and they needed wheelbarrows full of money just to buy basic necessities. This period had devastating economic and social effects, leading to political instability and the rise of extremist movements. It's a powerful reminder of how inflation can destroy wealth. Now back to our list. Our second pick is AbbVie, known by the stock symbol ABBV. AbbVie is a large pharmaceutical company that makes and sells medicines. They are part of the healthcare industry, which focuses on developing treatments to improve people's health. AbbVie offers a dividend yield, showing how much money you can earn from dividends compared to the stock price. But it's important not to focus too much on this yield. AbbVie uses about 80% of its free cash flow to pay dividends to shareholders, known as their payout ratio. AbbVie might be a good buy because they could be undervalued, meaning the stock price might be lower than it should be. This could be due to a recent major acquisition or new developments in their business that could boost their value in the future. The last dividend per share paid by AbbVie was $1.48. AbbVie Incorporated's quarterly dividend per share was $1.55 as of August 15, 2024. So if you owned one share, you would have received $1.55 in dividends. Finally, let's look at our top pick, VICI Properties. VICI Properties is a real estate company that owns and rents out properties, especially in the gaming, hospitality, and entertainment industries. They own famous properties like casinos and hotels. VICI Properties offers a dividend yield, showing how much money you can earn from dividends compared to the stock price. However, it's important not to focus too much on this number. The company uses about 75% of its free cash flow to pay dividends to shareholders, which is known as its payout ratio. VICI Properties is a good buy at the moment because they could be undervalued, meaning their stock price might be lower than it should be. This could be due to recent acquisitions or new deals in their business that could increase their value over time. The last dividend per share paid by VICI Properties was 42 cents. So if you own one share, you would have received 42 cents in dividends. When prices are rising, like in 2024, it's important to find dividend stocks that can help you keep up with inflation. By following these steps, you can screen for solid dividend stocks that are more likely to beat inflation and help you build wealth. 1. Look for strong companies. Focus on companies that have been around for a long time and are strong in their industry. These companies usually keep making money even when times are tough, which means they can keep paying dividends. 2. Check the dividend history. Find companies that have a good track record of paying dividends regularly and even increasing them over time. This shows that the company is reliable and committed to rewarding its shareholders. 3. Look at the payout ratio. The payout ratio is the percentage of the company's earnings that it pays out as dividends. A lower payout ratio, usually below 75%, means the company has room to keep paying and possibly grow its dividends, even if earnings drop a bit. 4. Consider the industry. Some industries are better at handling inflation. For example, companies in utilities, consumer staples, like food and drink, or healthcare often do well because people always need their products, no matter how prices change. 5. Check for growth potential. Look for companies that are still growing. If a company is expanding or finding new ways to make money, it's more likely to keep paying and growing its dividends. 6. Evaluate the dividend yield. The dividend yield tells you how much return you get from dividends compared to the stock price. While it's tempting to go for a high yield, make sure the company can sustain it over time. Whether you're an investor or a trader, it's important to understand that building wealth through dividend stocks offers both protection against inflation and the potential for steady growth. Time is a key factor in long-term financial success. Comment on your favorite dividend stock, and if you want to learn more about investing in dividends and becoming a more informed investor, stay tuned for our next video, and don't forget to leave any questions in the comments. Thanks for watching. If you found this video helpful, don't forget to give it a thumbs up and hit the subscribe button for more investment tips. Let me know in the comments if there are other topics you would like me to cover. Catch you in the next one. Your financial future is waiting.